Okay, thank you very much, everybody, and a very warm welcome to this roundtable session on the subject of green finance and the opportunities therein. Just to introduce myself, my name is Jonathan Rogers. I'm CEO of a company called Ostinato Associates, which is a public relations company based here in Singapore. I'm also a columnist for International Financing Review, part of Thomson Reuters, and I get to shout about Asian capital markets once a week for that. That's enough about me. In no particular order, I would like to introduce today's panelists, starting over there with Mr. Nick Robbins. And Nick is co-director, and he has a very swanky title of the Inquiry into the Design of a Sustainable Financial System, which is part of the UNEP Inquiry, United Nations Environmental Programme. Prior to his current position, Nick was head of the Climate Change Centre of Excellence at HSBC. Is that correct?
Yep.
From 2007 to 2014. Thank you very much. And to my left, I have Preeti Sinha, who is Senior President and Global Convener of the YES Institute in India. This is an Indian international public-private policy institute located at Yes Bank. Prior to that, I believe you were with the African Development Bank on the performance management side.
Yes.
Correct. Okay. And Priya Mathur, sitting here right next to me. Priya works for the California Public Employees Retirement System, popularly known as CalPERS. Sits on the board. She's also the chair of the Pension and Health Benefits Committee of CalPERS, overseeing the 8 billion per year of health benefit program that CalPERS brings in. And I also believe you're principal financial analyst for the Bay Area Rapid Transit District. Is that correct?
That is true.
Jolly good. Marvelous. That's wonderful to hear. And then we have Frederic Samama, who is Deputy Head of Institutional and Sovereign Clients at Amundi, which is the Paris-based asset manager. I believe has around about 1 trillion euros worth of assets under management in 30 different countries around the world. This is the introduction. So let's start off. Today we're talking about green finance, and one of the issues about green finance is an issue of definition and precisely what is green finance indeed. And I have, hot off the press, or not quite hot off the press, but from the G20 study group, a definition of green finance, which may help some of you, may help us. The financing of investments that provide environmental benefits in the broader context of environmentally sustainable development. There we are. So that is what we're talking about today. I would think that it would be a natural fit, given the state of markets and market development, that we would probably tend to be talking about green bonds for a large part of this conversation. Before I hand over to Nick, just as a preparatory introductory remark, it seems to me that we have had a major sea change in relation to green finance since the COP21 agreement in Paris, which was signed last December. And as we sit here in Singapore, it's only 2 days ago that we had the communique from the G20 for the first time in the history of the G20, speaking about green finance and emphasizing it for the first time. We also had a significant possible game changer in that China, the world's biggest emitter of greenhouse gases, has agreed to ratify the COP21 agreement, as indeed has the United States. Quite how that is ratified under the US Constitution, we don't know, but it seems to me that that's a done deal. So there is talk that with China and the United States move on Monday, we could indeed see the COP21 agreement actually ratified, although it doesn't kick in until 2020, as we know. There are some preparatory remarks. I'd like to hand over to Nick to talk a little bit more about the study that you are engaged in and how you think that sets the tone and has the potential to make a big difference with regard to green finance going forward, if you will.
Thanks very much, Jonathan. So yes, thanks for inviting me here. It's great to be with you at PRI in person. What I'd like to do is maybe just sort of set out a few things about green finance. I'm sure the panelists will go into more detail. Really sort of looking at what green finance means. I think it's one of these many terms we use. We have many different terms. Why I think the G20 intervention is important for us in the room. What this means really for institutional investors in terms of market creation and financial innovation. Maybe go into a little bit more in terms of the policy options that Marjun highlighted before the break, and then sort of maybe think about what happens next. Before I just make my sort of few words, it'd be interesting actually if you are from a G20 country, if you could put up your hands. Now the EU is a representative and Singapore is an observer, so put up your hand if you're in Singapore as well. Good, so that's most of you. That's most of you. 80% of the world economy, most of global emissions. It essentially is the body that sets the economic and financial framework. The FSB reports to the G20, and it really is it's the body that sort of shapes a lot of the coordination of macroeconomic policy. I think the main thing that's coming out of this year is that the finance ministries and central banks of your countries, G20 countries, are now all engaged on green finance, which includes the transition in terms of climate change, low carbon trajectories, resilience to shocks, but much, much more than climate change. It's about air pollution in growing Asian cities, water stress around the world, and the continuing depletion of natural capital, soils, and extinction of species through biodiversity. So this is a big agenda, and it's not just the Ministry of Environment who are interested now, but it's your treasuries and your central banks and your financial regulators. This is, I think, the big importance of the G20 getting involved in this, which I think is quite profound. And I'll come back to, at the end, I think, what it means for the engagement of institutional investors. So I've touched on the green finance side, so it's not just climate change, which I think is important, particularly for Western investors. There's a much bigger agenda out there, particularly about air pollution in Asian cities. It's not just about institutional investors. It's particularly about the banking sector, so I think relations between investors and the banks you own is important there. Insurance sector as well, and capital markets in terms of the scope. Clearly, from a policy point of view, it is about mobilizing capital. It's about mobilizing capital for the real economy, which will generate growth, which will generate jobs, and will move us to a zero carbon and zero pollution economy. So that's one thing. That's the sort of direct investment in the real economy. Also about managing the risks that we're facing increasingly from environmental shocks. And then the agenda we're all interested in here, which is ensuring that actually we have long-term secure returns to pay pensions and to reward savers. So the G20 involvement as well, I think, again, is interesting to see how it came about, because as Marjun suggested, it came about from essentially bottom-up leadership. From China, responding to the serious environmental challenges the country is facing, the central bank there launching a task force to actually respond to that, to see what policy levers. From France, not just being a very successful host of the COP, but also driving through its own domestic energy transition plan with the famous Article 173 in terms of requirements for institutional investors, and also potentially as well the Bank of England in terms of its work looking at the insurance sector and what does climate change mean for the stability of the insurance sector and the famous tragedy horizon. So the G20 work hasn't come out of nowhere. It's not just a high-level talk shop, but it's very much coming out of very grounded work at the national level. In terms of how it has operated, which I think is quite interesting potentially, UNEP has been very privileged to be the secretariat for this group, and it's been co-chaired by China and by the UK, and you have the 20 nations around the hall, plus the IMF, plus the World Bank, plus the FSB, and all these bodies. When we started in January, I must say that actually a lot of people around the room didn't really know what green finance was, didn't really know what environmental issues were, and really why was it important to them as a central bank, as a treasury minister. 6 months on, we now have a consensus agreement and increasing understanding by these treasuries, these securities regulators and central banks, what their role is in delivering the transition. And I think that is a very important advance, which I think can be built on. The third point is really this question of market creation and sort of financial innovation, which I'm sure the panelists will pick up. Again, green finance, responsible investment, and so on, these are not things on the shelves that can be picked off and implemented. These are the things that need to be created, in many ways co-created. And one of the things that I think has been very interesting, again, about the G20 process, it hasn't really been a closed government-to-government discussion, but very importantly, drawing on private sector experience. It's great to have the PRI. PRI has been one of the knowledge partners for that, really bringing in the experience of all of you, your experience, not just the good things, but the things that investors are still very frustrated about in terms of policy, in terms of markets, the things that need to be fixed. So thanks very much to the PRI. But I think in all the work that came out of the G20, it was very important to see that this wasn't going to be fixed just through government policy and regulation, that there was really a call on the private sector, on investors, to actually work with policymakers to co-create these new markets. So I think that's an opportunity. I think, as Marjun said, one of the big things that he's particularly focused on and came through in the G20 work as a whole is this whole question of capacity building, really building the skills and capabilities of financial professionals across the G20 so they are equipped to serve their clients in face of these big challenges. One maybe just sort of final point, if I may, I'm coming up to my end. I think just to go back to where I started, the finance ministries, treasuries, central banks, and financial regulators in your countries are now engaged on this issue. In January, many of them weren't. But one of the things that I think is very interesting in the G20 process is it's given a place where people can learn from each other, they can share experience, and then start their own process. I've seen that happening with a number of countries who've actually sat, listened, and are now going to drive their own processes back in their own regions. Very interesting, the European Union Commissioner in charge of sort of economy and finance coming back from the Hangzhou summit saying, we're going to launch a strategy for the European Union in terms of sustainable finance. I think we will see that more and more in most G20 countries in the next year or two. So important, again, to be ready to be engaged at the national level, but also at the international level in terms of thinking, what is your role in terms of shaping the markets so we mobilize the capital and deliver the goods? Thank you.
Nick, thank you very much for that. I just wanted to turn to you as an investor who sits quite a long way away, and I would like this natural focus here to be about Asia. There is talk of green finance being a quiet revolution, but I think the volume is being turned up, and indeed 2 days ago when we had the communique from the G20, that volume has gone very loud. How much urgency do you feel in terms of that agenda, in terms of asset allocation towards the green financial product in Asia? Because I presume you're able to look at the region. How does that figure on your agenda right now?
So if I could just take a quick step back before answering that question. So CalPERS has been quite engaged in this space for quite a while. We were very big supporters of the Paris Agreement and helped to provide investor input as that was being developed. And in fact, just in a couple of weeks during Climate Week in New York, we're going to be launching sort of our new initiative coming out of our Montreal Pledge and how we're going to engage companies globally on the issue of climate change in particular, and carbon in particular. So we're very engaged in this space, and we just in August, just a few weeks ago, excuse me, adopted a 5-year sustainability and governance strategy that very keenly highlights climate change and water risk as 2 key strategic priorities for CalPERS. Now, that being said, we have been very slow, admittedly, on the implementation side from a project finance and bond finance standpoint. We at CalPERS have quite a considerable home country bias in our fixed income portfolio, and we've only honestly invested in 1 green bond, and that is in the United States. So one of our challenges—
What was that? Who was that for, by the way?
That was Georgia Power.
Georgia Power, okay.
Yes. We also recently invested in Desert Sunlight Solar Farm located in California. One of our challenges is that our liabilities are dollar denominated, and so our investments, it's challenging for us. The currency risk is particularly challenging.
Are you fully hedged on anything that you would commit to in Asia, for example?
We are not.
You don't do that, so you wear the FX exposure.
We are reviewing our currency hedging policy. We have, over my tenure, which has been almost 14 years now at CalPERS, we have gone back and forth on the value of currency hedging. It's a costly endeavor, and so it erodes returns.
So it eats into the yield, and therefore there's not very much point unless you have a deeper reason for doing that.
You know, the other challenge for us is the availability of data and disclosure and standards, and that is why another key strategic priority for us is really moving to more integrated standards and reporting on environmental, social, and governance factors as real material financial factors. That is a major push that we are going to be embarking on over the next 5 years, with an ultimate goal of global mandatory adoption in 20 years of converged standards. And so that's also going to be an important feature in our evolution of investing in this space in particular.
Yeah, okay. Frederic, almost literally off a plane from China.
Mathur, yeah.
You've done a lot of work in terms of your fund, the Amundi, in relation to carbon indices, carbon indexing. How important, how significant is that in relation to equity portfolios going forward? You know, maybe there is exposure to fossil fuels and so on. In relation to performance, I think your funds, we're talking about a quiet revolution. In fact, I think when you launched some of those funds last year, you outperformed to the tune of about 100 basis points in the US and about 50 basis points in Europe very quickly. So this is not a quiet revolution. This is something that is coming to fruition very, very rapidly. But to look at the indexing side, carbon indexing side, how important or how much of a trend will that be in terms of conventional mainstream investor behavior going forward?
We think that these low carbon indexes that, yes, we have co-developed with some asset owners are quite important. They are quite important because they're addressing one of the 3 main challenges that asset owners are facing when we are talking about climate change. It's about time horizon. Mark Carney talked about the tragedy of the horizon, the fact that when we were talking about climate change, very often investors were saying, well, it goes beyond my usual investment horizon. So they were saying, no, I don't consider that. So we thought that if we could have a product that would help buy time, it could be really a game changer. The other thing that was important with this index is that a lot of investors were talking about this asymmetry of information we don't know so well. And here we thought that by focusing not on the winners, but slightly more on the losers, it would be slightly more easier.
You think the market is mispriced in terms of, say, carbon risk or stranded assets? You think there's a mispricing, fundamental mispricing going on?
Absolutely. That's really the basis of this approach. And the one who expressed that in a very straightforward manner actually is Martin Wolf in the Financial Times.
Yep.
June 14, 2014. He said, you investors, you will pay the bill about climate change. You will pay the bill because markets being short-term oriented, they price the likelihood of polluting companies to be penalized at almost zero. But he said, if really you invest for the next 3, 5, 10 years, can you really make the bet that polluting companies will never be penalized? If you think that this likelihood is 5, 10, 20, or 50%, then you have mispriced risks in your portfolios. And that's your fiduciary responsibility to try to identify them and to reduce their weightings in your portfolios, period. We are not talking about saving the planet. I mean, you have NGOs, governments, that's their job. Here we are talking about risk management, and yes, risks that are not correctly priced for the moment. And
but here's an issue. Assuming that COP21 gets ratified and so on, and is effective come 2020, will that discipline that you're just talking about now, will that drop out of the picture, or will it continue?
The link with the COP21, you mean?
What you're talking about the mispriced risk and so on,
yeah,
that will continue to be one of your main investment
methodologies.
Yeah,
absolutely. And we think that it's only the beginning of a long journey, because when you talk about climate change, here we talk about carbon, we talk about stranded assets, but that kind of approach could be replicated on many other themes like water, for example. That is another risk, as Priya said, that now it's part of their risk assessments in their portfolios. And here we have exactly the same problem, is that we have a risk that is not so easy to quantify, and we don't know exactly the time horizon. So to start already to reduce the risk related to water could make sense. So yes, it's only, I think, the beginning of a long journey. And just to slightly connect with what Nick said before, so we have this risk management approach, we have the financial innovation, and yes, governments are stepping in now.
Yeah.
Why? Because first, they're super happy to see a new pressure on polluting companies. At the COP21, they were super happy to learn that investors were getting involved into climate change. And for example, you have the Montreal Pledge that is sending a fantastic signal. $10 trillion, 120 signatories. From the government's perspective, we're saying we are not alone anymore. We have new players joining us. And you have as well the Portfolio Decarbonization Coalition that gathers 25 asset owners representing $3.2 trillion and committed to align their portfolios with a low carbon economy for $600 billion. And that was another very strong signal being sent at the COP21. And so now governments are saying, okay, we have this new pressure, how can we accelerate it? And Nick mentioned the Article 173 in France that makes the carbon footprint mandatory, almost mandatory for all asset owners and asset managers in order to accelerate the process. And when Mathur says in his multiple reports, the amount of money needed to tackle climate change in China are so big that only 15% will come from fiscal resources.
Yes.
That means that his key objective for 85% is to mobilize the capital markets, so to mobilize the asset owners. So suddenly we have a new shift from this attempt to put in place cap and trade mechanism, taxation and so on, towards mobilization of new forces. And just to conclude, why are the policymakers so interested into this mobilization? Because we know that the asset owners, being already interested into climate change, are representing $95 trillion. We know that because that's the size behind the Carbon Disclosure Project. So that means that each time we succeed in getting a shift from I'm interested towards I'm taking action, the 0.1% is a $100 billion of reallocation of capital or debt from polluting companies toward clean companies. So from a policy making perspective, it's absolutely huge. So they're discovering that there is a leverage here that is based on economics, where you already have instruments, where you already have some leadership around the planet. So it's just a question of accelerating the process.
Okay, thank you very much for that. I mentioned that we would try to, as it were, steer the natural conversation here towards the green bond market. And I wasn't leaving you out, not last but not least, Preeti.
Yeah.
We seem likely to be on target to have $100 billion worth of green bond issuance, labeled green bond issuance, globally this year, from I think a 44 billion total last year. People often overshoot on their estimates, but it seems to be the case that we're going to have a record-breaking year. What is going to be the source of that bond issuance? Naturally, I think in terms of what has been done from a regulatory perspective, it would certainly be China, and you can tell us more about that later, and it would also be India. And India has also recently, or this year, put its guidelines in place for green bond issuance. You had a very personal experience in terms of execution with a deal for Yes Bank that was a sort of a groundbreaking deal. So can you tell us a little bit about that deal and why you think that it was special, and how naturally, if there's a follow-up to that, would it be coming in the same form, or would it be in a modified form?
Sure. I think I'd like to pick up from where Frederic left off, in the sense that the involvement of the government and the private sector is very important at the same time. So if China is looking at policy, so is India. So just to give the context that you may or may not know, that India has this target of 175 gigabytes in renewable energy by 2022. Everybody knows that. So that we feel requires about $100 billion in investments over the coming years.
Yeah.
The government's been putting out some fiscal, expenditures. It's put 1.2 billion at one planning commission stage. Now we've done another billion, but that still leaves a lot of gap. So where the private sector comes in, and then again, to tell you about Yes Bank just shortly, it's the 5th largest bank in India, just 12 years old, at a market cap now of 7 billion, which is 24x the IPO. So young bank, and therefore very innovative, trying to bring all that's going on elsewhere to the country. So in that sense, we also launched India's first green bond. This was a $75 million bond, followed by a green shoe option of another 75 million, so 150 million in all. And then later, we did a second round with the IFC investing in a $50 million tranche through the Masala bond. So this was IFC's first investment into an emerging markets green bond structure. So that's the grounds that we are playing in. We use KPMG as our accreditation agent. I was reading, they're coming up with a new paper called Gearing Up for Green Bonds themselves. So I think for us, we are using these proceeds to invest in renewable energy, energy efficiency, solar, wind, and biomass projects in India. So we will continue focusing on this area, maybe coming up with further green bonds. There's now talk of blue bonds to focus on perhaps the water sector, and that's something in play right now. In addition, just overall in terms of financing, we have been financing about 3.5 gigabytes of, 3.5 gigawatts of green energy in India, which is, let me read some figures. Wind, 1,861 megawatts of wind, 1,562 megawatts of solar, and 109 megawatts of biomass hydro.
Just a question for you. With the Yes Bank deal last year, and the Masala format was extremely interesting. The development, the IFC Development Bank was part of that bid, and it was mutually beneficial. Could you do that on a standalone basis now without the IFC going forward? You can do that.
Absolutely.
Second point, and this, I can open this to everybody here. Are the development banks doing their bit, for green finance? Because they've always, at least if we look at Asia, they have historically opened up domestic bond markets for benchmarking purposes. You go into a reasonably small market domestically, they issue to create a high-quality benchmark. Is that the format that we're going to be seeing in Asia, that the development banks kick off and start off? This is excluding China, but possibly including India. Or have we reached a stage of sophistication whereby we don't need these development banks to go in and set the tone and do the benchmarking?
So just in terms of masala bond, and again, that's rupee denominated bonds listed internationally. So we've been seeing a host of other bonds in other sectors, particularly financial institutions, listing on the London Stock Exchange. So that's certainly there. I guess the concern is on the currency, how to manage the currency risk. So the strategy has to be for the long term. If you're a long-term investor, that risk sort of stabilizes over time.
Yeah.
In terms of development banks, I think they're a valuable partner. Obviously, the market's very big, India's very big, the private sector is playing a role. For instance, tomorrow we are having the CFO of the World Bank in India talking about these issues on renewable energy and so on. So I think there is a role to play, but definitely the private sector is stepping up. The banks are very active in this space and looking for more innovations, so we hope to take back some lessons from here too.
Excellent.
If I could just jump in briefly.
Please jump in, but I was going to jump ahead. Go ahead, but I had a question for you anyway.
All right, well, let me
ahead.
start and
Please go
maybe I'll address your question. So yesterday we had a global dialogue on sustainable stock exchanges. And I think there's one of the things that came up during that conversation was the role of stock exchanges in helping to establish standards for green bonds. I mean, it's one of the issues is that what is the credibility and integrity of a green bond? How can, as an investor, we be confident that it really is going to deliver both on the impact and on the financial performance side? Yeah.
Okay, thanks for that. What I was going to ask you next is that it seems to me that the massive question, the overriding issue, if we look at green bonds, is that there is no pricing advantage. I mean, from an issuer's point of view, they do not get to price through their implied yield curve. More to the point, they have to employ third-party opinions and assurance and so on. So at the end of the day, the cost that accrues to them in basis points from the constant monitoring, third-party monitoring, it is not attractive. From the investor's point of view, if they're agnostic between conventional finance, brown finance, if you will, and green finance, what they want to see is an outperformance of the green bond product in relation to the yield curves of the conventional product, but we haven't seen it. So the question you ask is, if you're agnostic, why bother? If you've had the conversion on the road to Damascus, you will do it anyway, but if you're agnostic, you won't, because there has not been any noticeable outperformance. Nick, you seem...
Well, let Priya go first.
Well, I think Nick might be better positioned, and Frederic might be better
he looks as if he's off to he wants to go off to the races on that one.
I'm not sure that investors are looking for outperformance. They are looking for neutral, at least equivalent performance. So I would just add that, but I'm sure...
I think one of the interesting things, and maybe, I don't know if you heard when Marjun was speaking, he mentioned that the introduction of mandatory environmental disclosure on Chinese securities markets was for equities companies and issuers of bonds.
Yep.
So one of the things that is going to be happening is actually, I think you're increasingly going to be leveling the playing field by essentially requiring all bonds to actually disclose environmental performance. You actually start getting credit rating agencies, and the PRI, with the inquiry, worked with many investors to get 6 credit rating agencies, including Dagong in China, to actually start saying they're going to go through a collaborative process of integrating. So I think on that side, you raise you get visibility for the embedded risks in vanilla bonds.
Do we need green indices? I mean, in terms of fixed
I'll leave Fred that. But maybe just 2 further points. One is actually, I think most issuers have found that there is a diversification of investor base, which I think is quite useful. And I think because there is actually more demand than supply at the moment, there can be a little bit of advantage, which overcomes this sort of sustainability spread. But Fred, I don't know if you wanted to add.
You raise a very important point about this. Green bonds are good because it's about signaling. It's easy to invest in and so on and so on. So that's a good product, and we always have to keep in mind that for the moment, out of this $95 trillion of assets, very little is being done. So every little first steps are extremely important because the objective is really to get the shift. So we have to keep that in mind and to be very pragmatic and little step by little step. So green bonds are part of this strategy. That said, you briefly touched upon that, is we have a slightly bizarre situation with the green bond market because on the one hand, you have polluting companies issuing green bonds. And you really want to invest into massively highly polluting companies that are just issuing little green bonds because they have a solar panel, a project, or whatever. That's a question. And on the other side, you have very green companies that are saying, why should I pay the extra costs? Exactly your point. And say, no, we are already green, we don't want the cost of the report, and so on and so on. So it will be the only time I mention Amundi, but at Amundi we have decided to launch a green bond fund that say that we will make a screening of the green bonds in order to avoid the polluting companies, and we will invest into green companies having issued standard bonds in order, again, not to penalize, I would say, the good guys. And one of the beauties of that is that suddenly the underlying market is shifting from 50, 60, or whatever billion plus towards 600 billion. So the quality of the portfolios is getting, it's getting much better. So we try to do that because for the moment we are facing that situation. Hopefully in the future the disclosing will be for everybody and we won't have to get this, this screening, but that's our current approach. Mm-hmm. So we try to address that question.
Yeah. I mean, is there the concept, if, for example, you're looking at a 10, 15-year, 20-year maturity bond, to give an example, that the regulatory oversight, the risk of stranded assets, the risk of the variety of assets, the asset mix and so on, is going to be at risk. So therefore, once all of this becomes much more mainstream and common practice in relation to regulation, that suddenly there should indeed be a shift. There should be a massive seismic shift from conventional assets into those which are, whether they are labeled green or non-labeled, you know, climate aligned and so on. Are we now witnessing this revolution, as it were? Is it kicking off, or is it a false dawn, do you think?
Well, I mean, this is why this disclosure question and the standards question is so crucial to us at CalPERS, and I think for many investors, is that we don't see these risks as non-financial risks. We see them as true financial risks, yes, and material to the performance of companies. And so in terms of bonds, exactly what Nick said is that, you know, whether it's labeled green or not labeled green, we want to see how the company is performing against material metrics not just in terms of environmental climate change, but also in terms of human capital management and governance as well.
The general ESG
yes.
criteria, yes. Okay. I'm looking now at the clock, and according to the timetable, we will now open up the floor to some questions. If anybody would care to grill our panelists, I'm sure that they would love to provide some appropriate answers. Somebody over there. Please, is there a microphone? Yes, thanks.
Thank you. Graham Cooper from Environmental Finance. A question for Frederic. Could you just clarify, please, your policy in investing in green bonds from pure play green companies?
We first, when it's, I wouldn't say our policy, because we try to co-develop products with our clients. So it's not something we are imposing on portfolios. So both for the low carbon indexes or for the green bond funds, it has been a dialogue with the asset owners that who wanted to invest into these products. And the outcome of these conversations were to say, so as I briefly said, we put aside the polluting companies, even if they have issued green bonds, and then we will look at who are the leaders in their industries in terms of green activities. The obvious example for the auto car makers is that if we have the choice between Volkswagen bonds and the Toyota bonds. Obviously, we will invest into the Toyota bonds. So that's what we do. So Toyota has not issued a green bond, but in their sector, they are ahead of the curve. So that's the kind of companies we will select, or Schneider in France, and so on and so on. So we do that green analysis of the company.
Presumably, you want some analysis of or some proof of the use of proceeds as well.
Sorry?
Presumably, you want some extra reporting on the use of proceeds from the bond, though.
Oh, yeah, but you already know the activities of the scope of activities of all these corporates. So my point is that you already know what kind of business is Schneider involved in, or Toyota, and so on and so on. So it's just part of the usual analysis that an equity or a bond analysis is doing in-house. My point is, when we talk about the use of proceeds, well, you already know what a company is doing with its money. So the information is already available, and so that's what we are doing. We are doing our own analysis.
Please.
Thank you. Robert Shah from the Luxembourg Stock Exchange. We are very active in listing green bonds and have roughly 50% of the world's international green bonds listed in our exchange. Now, we are very happy about the developments and the record-breaking year that it will likely be in 2016. But on the other hand, I must say, when we are looking at what is needed as investments in order to sustain, in fact, the objectives of COP21, then we are talking about peanuts here. And there are a few handicaps in the market, obviously. One is, it was referred to, a lack of standards, and also the issuers' reluctance of paying up on pricing. Now, my simple question is, I have the impression that PRI regroups enormous amount of capital, and that means purchasing power. Well, what does it take for asset managers and institutions to stand up and push this market forward? Because the demand is obviously there. The demand and the offer will only increase according to more standardization if asset managers have the courage of saying, we want to move that way.
Can I nominate you to answer that question?
I don't know that I have an answer to that question. It's a good question. I'm sorry, nothing's coming to mind except for the effort to really push for greater standards, and that will help, I think, lead to appetite, because there'll be more confidence in the green bond market. But that's what's coming to mind for me.
Nick's going to have a go.
Well, I mean, I think it's very interesting. One of the very good things about green bonds is it actually does enable us to quantify for one bit of the investment world how much money is flowing in a green direction. And that is not the same in the banking sector. We have very little visibility, more generally within the investment sector and so on. So I think we're at a stage where we're moving from the sort of age of commitment. We commit to things and we introduce processes to the age of reallocation. So I think the things which would happen already, we have investors committing to the Montreal Carbon Pledge on the emissions side, but I think much clearer transparency on allocations to green investment. Now that will force people to say, what do you mean by green investment? So then we'll start having common standards so that we can look at asset owners, asset managers around the world, that they have 3% or 4% or 5% or whatever it is, and it is clear to their underlying beneficiaries and to the market where they are putting their money. And that would drive markets.
It's a very good point, though. Sustainability reporting for asset owners and investment managers is evolving. And as we move towards integrated reporting from the asset owner side, I think that will also help move this forward.
To follow up on what Priya and Nick said, is that there's this, and Nick said that at the very beginning of the conversation, this Article 173 in France that was passed, a law that was passed December 29 last year, so about 6 months ago. This law is quite unique around the planet, and it says that all asset owners and asset managers have to disclose how they're integrating climate change-related risks into their portfolios, and second, how they're channeling their investments to help the shift towards the 2-degree economy. And so it's super important. It's super important because first, it covers all the assets. So it's not only the equities, but the bonds, the real estate, the sovereign bonds, everything. So it's important. Second, the government recognizes that we still don't have standards. So for the moment, instead of saying, here's what you must do, it's kind of competition between different ideas and providers to come with smart ideas. And third, when people will analyze the risk, for sure, after that, there will be a demand for products. So it's a very smart way to accelerate the call for ideas, projects, and so on and so on. And from the policymaking perspective, nobody can be against a law that says, I would like to know about the risks of my investment arms. Because at the end of the day, we know that governments will pay a big part of the bill about climate change. So it makes a lot of sense that the government is saying, especially for public pension funds or public or sovereign wealth funds or public insurance companies, to know how the investment arms are exposed to climate change. Nobody can raise their hand and say, no, we don't want to know what kind of risks our investment arms have. So it's a quite powerful, flexible, pragmatic, low cost in terms of politics, and super easy to replicate around the planet. And not only in the developed countries, because in the developing countries as well, you have sovereign wealth funds, you have public pension funds, so on and so on and so on. So that idea really could work all on the planet. And then, again, asset managers that are trying to do their jobs, and I hope that we are part of that group, but the pressure on our shoulders will be bigger, and yeah, so there is a very easy way to do it. Does it answer your question? Okay.
Any other? Oh, please.
One right over there. One right over there.
Hi, Nathan Fabian from the PRI. It's probably a career-limiting move to ask one of your board members a question in an open forum, but I'll give it a go.
It better be a good one.
Yeah. So I'm wondering, is ESG integration in fixed income portfolios enough on the demand side to get us the green bond take-up that we need and expect? Or do we need something else?
Well, CalPERS is we're still on the journey. So I can't speak for all investors, for all asset owners, but we're definitely still on the journey. It's an area that we continue to look at, and clearly our own allocation of capital does not reflect a significant commitment at this point, and it's really based particularly on this issue of integrity of the market. What, Dr. Majun mentioned earlier, what is the definition of green? And okay, maybe we need a definition of green, but I honestly don't think that that's going to be enough, that really these standards, which I know I keep repeating myself, but that the standards are going to be important in evaluating bond issues one against another, companies one against another. And that will help, I think that will help stimulate more investment capital.
Thank you. Nick, is somebody over there? There you are.
Thank you. Asger Garnak from the Danish Ministry of Energy and Climate, one of the few government people around at this event, I think, but I would just want to confirm what Frederic said about the enthusiasm of governments for this engagement by private investors in this field. And one question I would like to ask the panel is, what can governments and other, you could say, public type players like multilateral development banks do to enhance the investments in particular in emerging economies, because that's where the bulk of the low carbon investment is going to be needed. And one of the priorities from our side is to get also the Danish pension funds and others more engaged in investing in these markets that from their home turf are seen as more risky and less well known. What can governments and similar players do to help catalyze increased investment? And this is very much in line with what Mathur was looking for in his intervention. We have a little bit of public climate finance that we can allocate, and we realize we need to use that in clever ways to mobilize the private sector. So any advice going forward from your side? Thanks.
I mean, I think that's a good point, and you were raising it earlier about the role of development banks. Clearly, development banks have been very important in the green bond market. Essentially, they seeded it in many ways. I think also in other areas, in terms of equities, obviously they can actually seed funds and so on. But probably their biggest role, rather than maybe direct investment, is going to be in buying down some of the risk through risk mitigation mechanisms, credit guarantees, and so on. That's not just developing countries; it's worked in Europe in terms of project bonds and so on. So I think there's a role there, which obviously has a very high potential leverage, given that the default ratio for those guarantee instruments is generally very, very low. So I think that would be an area where they could really sort of look at projects which are credible, but perhaps are not meeting the credit rating expectations of investors. You bring them up to those expectations, then the institutional money will flow.
One other thought, and it's not really unique to green bonds particularly, but you know, in the U.S. and I'm sure in some other countries, we have a history of fossil fuel subsidies, and so moving away from fossil fuel subsidies towards more green green subsidies might be a way to help stimulate take up as well.
Just to add a point on the government, I think you started off with the government involvement. So for instance, in India, the government has now a Ministry of New and Renewable Energy. This is kind of the overarching name for the Ministry of Power and Coal. So the same minister looks after both. So obviously the big focus on changing direction. So they host a very large conference called Reinvest in India, which tries to attract investors, investments, etc. And for India, and particularly the oil bill is one of our largest import bills. So as that goes down, as renewable energy comes on board, then it will have a positive effect on the currency too, which then helps the whole global play. Thank you.
One other thought is around infrastructure, that we've had a very challenging time in the United States sort of getting more renewable energy or green infrastructure projects launched in a way that is accessible to asset owners. So involving asset owners early in the discussions as these projects are being developed and designed and the financing being structured, I think would also help facilitate more engagement.
Depending on who the next United States president is indeed, right?
Could make a difference.
Could make a difference. Somebody here now. Thank you very much.
Thank you. Jared Noonan from the Australian Council of Superannuation Investors. The panel has made references to the quality of green bonds at various stages, and I'm wondering whether the panel might comment on whether they think that ratings agencies are appropriately equipped to adequately rate such bonds to the satisfaction of potential investors.
Maybe.
We're working on it. PRI actually has a major project around working with credit ratings to improve their attention and the quality of their analysis around environmental, social, and governance factors, and the integration of that into their credit ratings. And several credit rating agencies are beginning to step up around this, but we by no means have full adoption yet.
So I think you have Moody's and others like it, which are developing their own criteria for the green bond side. I think it's important for them to do that, but I think probably a bigger focus is actually the core integration of environmental risk in overall credit analysis. I mean, they do have environmental capabilities, but maybe they're not necessarily the best place to do, particularly if you're looking at environmental quality of bonds. I mean, I think they're building up their capacity, but their core focus, I think, is on the creditworthiness aspect.
All right, I think our time is up, actually. I just wanted to thank... okay, maybe we have time for one more. Okay, one more.
Yeah, she has a mic.
Okay, one more question. Thank you.
Josephine Toll from Hester Superannuation Fund. my question is to Priya. You spoke about the standards that are needed to compare our bonds against each other, and also the integrity of the bond to ensure that it's delivering the standard that's required. From an asset owner perspective, how you mentioned that you did invest, that CalPERS did invest in a green bond. What was the board looking for, or the investment team looking for in that bond in particular to get that across the line?
It's an excellent question, and I'm afraid it's not really a question for me. It's a question for our investment team. So I'm happy to connect you with our own fixed income team if that's helpful. But that's a little granular for me.
Any other? Are we? I think we're done. I guess I just want to thank all of you very much for a very stimulating discussion. Thank you very, very much indeed for coming here today.
Thanks, John. Very good.
Thanks.